Here we are with another episode with another friend of mine, someone that I've been fortunate to do business with, interact with a lot, and definitely have some good nights and jokes and stories together. With Next Level Income, the one, the only Matt Fore. How are you today?
I am fantastic. Now that I know you're such a good golfer, we need to go out golfing so you can teach me a thing or two on the course.
If I have to customer service and take people to the golf course, I guess that's my fate. So
Yeah.
I would love nothing more than that. But let's talk about yourself. Before you got into real estate, give us your background. Obviously, you got the Iron Man information back there. Maybe you want to touch on that. But what did you do before you get into with Next Level Income, and how did you even find this world to start with?
Yeah. So I'm based out of Nashville, Tennessee. In my professional life, I've spent over a decade in sales and sales leadership roles at some of the largest technology companies in the world. And how I got involved in real estate is back in 2016, 15, 16. I was a part of a huge net new deal for the company I was working for at the time. And it was net new, it was a large deal. I saw the commission check that I was going to get, and my mind started wandering about like, how was I going to spend that money? I grew up in East Tennessee, so I've never really been big into nice houses, cars, watches, things like that. I knew I wanted to invest that. And so I started looking at a bunch of different options. I was told from people you should look at Bitcoin, treasury yields, stocks. And then I had a friend that said, hey, you should look at real estate, cash flow, tax benefits, appreciation. It checked all the boxes that I was looking for. But then, Craig, part of my story takes a turn. I got a call from my VP the week of Christmas that said I wasn't going to get that commission check, that I was only going to get 2 cents on the dollar. And what upset me about that is like everybody got paid differently on that. So basically, they just looked at it and said, okay, let's value everybody based off of what we think happened in this deal. So at that point, I was already further down the rabbit hole of real estate, rich dad, poor dad, bigger pockets, all that kind of stuff. So while I was upset at the time and very furious at the time, I got turned on to real estate. So bought my first property 3 months after that, started doing some fix and flips, burrs, all that sort of stuff, and then got into commercial real estate. So that's my story.
Well, and I think we spoke about this when I was guesting on your show, maybe just over some years, but I think you've kind of explained that you kind of got into this world and now you've got a lot of your peers asking, hey, how can I do this? Right.
That's right.
So were you kind of the pioneer of your circle and whatnot who were kind of thinking in this light? Because not everyone thinks about real estate all the time. I'm a little bit sick in the head, I guess, if you will. I was always thinking about kind of making a buck in real estate, like even when I was a kid. I was watching HGTV, like flipping shows in Sports Center. So I was always thinking about this. I always knew that was going to be something to the tune of real estate was in my future and in the cards. Where and what exactly was the unclear part, but real estate was the certainty.
Man, I had no idea about that stuff growing up. Again, I grew up in a town of like 7,000 people. We were a coal mining town that the world has just passed over. I didn't know anybody whose parents combined made over six figures. So it was a different world that I kind of grew up in. And yeah, I guess I was a pioneer in my friend group. It is funny that happened to me in my mid 20s. And now those decisions I made are starting to compound and I'm starting to see the fruits of those. Whereas the people that thought I was crazy at the beginning and thought I was going to lose all my money because of the '08 recession was fresh on everybody's mind. And they knew somebody's uncle that lost money in real estate kind of thing are starting to come back to me and be like, hey, how do I get involved? How do I get cash flow coming in the door? So, yeah.
Yeah, and then you kind of mentioned as well that you were doing that right around the 2008, GFC kind of time period was when you kind of got your investment bug in you.
Yeah, I right once I graduated, so I graduated college in '08, and that the GFC was going on at that time. All I could really remember at that time was that it was really hard to get a job, and I didn't kind of really understand why.
Yeah, it's all
So I went to
relative to what it's all relative to what
right.
you're used to. So if that's just what you came out in, that's what you came out in. But if you're in some vibrant, .com bubble boom, you were basically everyone's giving out a job, or maybe what we were like a couple of years ago when everyone was hiring like crazy in the ZERP environment.
Yep.
Yeah, well, it was easy. You take it for granted, right?
Yep. Yep. So I decided instead of getting a job, I was just going to go to grad school. And I remember I was like a gym manager during that time at the school's gym because I'm really big into exercise and lifting and all that kind of stuff. And I was just reading time Newsweek, all that, talking about what was going on in the GFC. And that's when my like investment nerddom kind of turned on and I was exposed to that world. And it's an interesting kind of correlation because I grew up dyslexic. I
Same.
don't deal well with words. I deal better with people and numbers. But the only book I remember reading growing up was a stock market book, and when I was in seventh grade. So it was always in me that was interested. I was interested in that, and it took like a great financial crisis for me to like really get the bug and the itch.
Yeah. Well, it's funny. I think some people grow up thinking about money, or some people, it just doesn't occur to them, like they don't care. I can't say that's what about me. I always think about how is I gonna make a buck. Maybe I had a chip on my shoulder or something, but I was always thinking about how am I gonna make a dollar. It's like, well, real estate seemed like a great medium to do that in a vehicle, and I like houses and so on and so forth, and the design aspect of it, and such. So I was like, oh, perfect fit for me.
I always tell people too, like even if you don't care about money, like I'm not trying to be what's the Mr. Burns on The Simpsons and like counting my pennies and Scrooge McDuck and all of that. But money is the language of the world. Like you need money to survive, so you should at least have a general foundational understanding of money because you need it regardless of whether you care about it or not.
Yeah, well, and speaking of money, that's what we raise to fuel and fund our projects and some of our lifestyle as well. So let's get into the next level income investment thesis that you've got here, and what you look for, and kind of what's exciting you right now, because we're in such a different environment today than we were a couple of years ago.
Yeah, I would say so. Our underlying investment thesis is we invest in cash flow generating assets in the Southeast where we feel like we can add some sort of value add component to it. Now, when I say value add, everybody's mind immediately goes to 1970s apartments, renovate them, pump in a bunch of capex, all that kind of stuff. There's a ton of different ways that you can add value, from improving operations, increasing rents, lowering expenses through negotiating contracts, different things like that. So that's what we look for. I always tell people, like, if you're looking to do development, you can make a ton of money doing development. You can also lose a ton of money doing development. So for our investors, what we're looking for is to preserve capital and then offer a better risk adjusted rate of return. And we do that through buying cash flow generating assets in the Southeast. In terms of what makes me excited, I mean, my inner nerdum goes through all sorts of different asset classes, and I like to keep up on the markets in that sort of sense. But really, I think right now in real estate, we see a lot of people who bought wrong during 2000, 2001, 21, 22, that are now struggling with their properties, trying to figure something out. And on the eve of a rate cut, we're filming this in October, or I'm sorry, in August, on the eve of a rate cut, now is a perfect time to buy real estate. Because I've noticed over the past 4 years, more than anything, real estate is directly correlated to the treasury market. So if you see rates go down, usually prices go up. So now's a great time to be in real estate, and we're ready to keep going.
Yeah, well, you raise a lot of good points, and I would love to hear specifically into the weeds of the vehicles in which you choose. Of course, Next Level and Lone Star Capital are best of buddies, and we partner together. Of course, many people know Chris Larson. Matt and Chris work in tandem together. They're an amazing team, and if we get Chris and Matt working with us, we know we've got a really good deal because they see deal flow all the time, and I believe we're one of the only sponsors that they work with, but you want to work with people like them who only say yes to a couple opportunities in the multifamily space because they have such robust options. So it's such a vote of confidence that we even are one of the preferred sponsors that they work with. So
Yeah, you're
yeah,
making me blush over here, but I'll flip it back on you. We spend a lot of time with a lot of different operators out there. You guys by far do one of the best jobs, from the detail orientation of the deal rooms that you put together, as well as just when I call you up and ask you a random question I don't expect you to know the answer to, you know exactly not only the answer, but where I can go see it for myself. So I'll flip it back on you.
perfect. I appreciate that. So let's learn about some of the deals that you kind of go into. So you do
Yes.
multifamily with us, but maybe just explain what you say yes to and what you look for from a value creation perspective, and I guess what you've historically done, maybe what you're doing moving forward.
Yeah. So our investment thesis of preserving investor capital as well as providing a better risk-free rate of return than what you can get elsewhere. really allows us to look at several different, not only asset classes, but narrow down our thesis within the asset class. So we're involved in multifamily, mobile home parks, both on the housing side of the equation. We really were early to the car wash space, we think. We were kind of chatting beforehand. KKR came in and did a $850 million acquisition of a car wash brand. We hope that they will come look at us next, but that has really, private equity has woken up and kind of seen the value of that space. And then the last is we play in the private credit market a little bit. We have a fund together around just providing debt to fix and flip lenders out there on short term basis.
That's awesome. Yeah. So what do you look to? Oh, actually, well, I guess keep going because I know you have a couple more.
Nope, that's it. Yep, those
So
are the asset classes we're in.
and then mobile home parks as well. Are you dabbling there?
Yes.
Yeah.
So in the housing space, we focus on multifamily and mobile home parks. And I often get questions like, why do you do both? Our multifamily business is built out in more of the A class space. So it's usually 2018 and newer vintage. We don't really touch anything that was built before 2000s. And the real reason there is that in 2019 and 2020, we saw that C class assets in the multifamily space were starting to compress in their cap rates. So what typically should trade at like a 8 to 10 to maybe even 12, depending on the market, was starting to trade at a 6, 5.5, and maybe even 5 in some certain markets. In the A class space, we think that A class assets, multifamily assets in major metropolitan areas should trade around a 4 cap. And those went down to like 3.75, maybe 4.25, depending on, again, the market space. So the elasticity of the A class is very, very narrow, and the elasticity in the C class is very wide. And so as that started to compress in the C class, we decided that that's not an asset class we want to go after. Sure, people are still making great money there. Sure, they're adding value, but we didn't want to take on a bunch of risk of pumping in a bunch of CapEx dollars and hoping the other side of it that we would be in a good, favorable cap rate environment. So I explain all that because the reason why we got in the mobile home park space is there's a dramatic need for affordable housing in our country right now. You all are doing a fantastic job of helping address that needs with some of the tax abatement programs that you're doing in Texas, specifically in Houston. But there's still going to be a need for affordable housing. And call it what it is, mobile home parks are affordable housing for a good deal of the population out there. It's an opportunity for them to own their own home, live in safe communities, or if they're going to rent at a way more affordable cost. So we can talk through a little bit more of that, but that's kind of why we ventured down that path, is because affordable housing is a need. We see the demand growing, and mobile home parks are one of the only asset classes in commercial real estate where the supply is shrinking. So if you have demand increasing, supply shrinking, you don't need to be an economics professor to know that's a good economic position to be in.
Yeah, I was actually going to mention that and touch on that. So we at Lone Star, as you know clearly, we look to buy deals in which there's not going to be much supply coming to the area because your number one contributor to hurting your property is probably people leaving or you getting undercut by the marketplace because, a developer built, sold, and, now your property is not as sexy as it once was. And, the ratio gets imbalanced. Mobile homes is very interesting because NIMBYism, which is not in my backyard, is a very real thing in that sector. They seemingly aren't able to get zoning or passing in most of these instances to get more mobile home parks. The other thing about mobile home parks that's very interesting as well, which I look forward to touching on both these things, is the premise and the idea that these deals offer really great cash flow as well, but you can't build them. So you can't build them, you can't develop them, and they're also very, by and large, owned by mom and pop owners as well, making it a substantially less efficient market. When you get the assets that we're playing in, which is 150 plus unit properties in the Texas Triangle, for instance, guess what? Everyone and their mother, for the most part, is aware of them. There's not really many off-market deals or screamers or unicorns that come up. But if you play in the mobile home space or, just some other asset classes that aren't as efficient, if you will, maybe smaller multi, you can find those really unique deals. Now, With that said, the contrary is that you're probably a lot more stable in our asset class because there's always a floor and a ceiling, or a floor to the marketplace, and it is just a very incredible asset because the number of buyers and the dollars put there. But I'd be curious to hear your perspective on all those things mentioned.
Yeah, I mean, beautifully said. It's really hard to do $100 million off-market transaction unless you're Blackstone or the Saudi Arabia wealth fund, sovereign wealth fund. However, we know people in the mobile home park space. Actually, I've got a friend who lives here in Tennessee with me. He's been just cold calling park owners, and he was able to do a deal off of just one cold call. Now it's a smaller park; it's 35 units, 35 pads, but it's just a mom and pop that they've never even had somebody knock on their door and try to buy it. The thing I want to touch on with the supply is zoning is an issue, but I often get that question like, why don't they build more of these and all those sorts of things? I
You think
mean,
it'd be perfect because it's affordable and you don't really need that much infrastructure, and you could basically just take a parcel and within probably 3 months, 4 months time, if you got permits there, could be ready to put trailers on it, right? Like it's
yep.
not, it's very simplistic. It's a little bit of sewage and concrete, no?
Yeah, it's not very complicated. I just think it's if you're a city council person in charge of Davidson County, which is Nashville, Tennessee, where I live, and you're looking at it and you're saying, okay, I've got all this valuable land. Usually, if you look at the demographics of a mobile home park, somebody that lives in that, they are going to take more resources from the state government tax funds than they are going to provide in. I don't mean that as derogatory as it may sound. I'm just stating facts if you looked at data. So if they're in charge of that land, they say, "Hey, I can offer affordable housing, or I could give it to this developer and do some sort of tax abatement, but they're going to build something that brings Amazon here that's going to bring 50,000, 25,000 jobs that I'll pay over $150,000 a year." Through this process of being in the mobile home park space and knowing some people in the affordable housing community as well, it's so crazy to me that everybody wants to talk about affordable housing until solutions are provided. And then it's, well, we could still develop this to be a class A mixed use development where we'll put a Whole Foods, have Amazon jobs on top, and have these nice $4,000 a month apartments where they will, increase their tax revenue base.
Makes sense. So basically, they're just looking at it that and not really wanting it there for kind of, I guess, those reasons there. I guess it makes it look a little bit less cosmopolitan, if you will, to have
That's right.
mobile homes as opposed to the brandful, beautiful anchor tenant with Whole Foods and such. That makes sense.
And that's not just mobile home parks too, right? I've got a friend and a contact who they go out and develop affordable housing using like public grants and things like that.
Yeah,
And the
life
whole
tech.
thing, yes, exactly. And Amazon gave them a grant to do some development for some of their workers that are coming into Nashville, just as an example. He faces the same problem. It's like, hey, I can give you units that are $1,500 a month when the average rent is $2,500 a month, but it's not going to have the Whole Foods. It's not going to have the new pickleball courts and all those sorts of things and the amenities that we would expect to see in a brand new property. And he has trouble getting the city council to abide by that because of the cosmopolitanness of.
Well, it's brutal, and that's kind of the reason why we have the public partnerships that we have with the city of Houston and Texas, frankly, and why we always want to be on the cutting edge because unfortunately, it's very challenging, if not impossible, to incentivize people enough to preserve affordable housing. But most people are really living paycheck to paycheck. I actually just had Nick D'Angelo on a podcast, which should be released just, I think, a week before this one. And he made a very interesting comment, which is right now specifically as well, 59% of people think we're in a recession, and 39% of people are, interestingly enough, living paycheck to paycheck and really month to month getting by. Well, that's different because 37% was the number that felt that way, living paycheck to paycheck during the GFC. So, those numbers are
Wow.
really interesting to think about. And that's due to inflation really hurting people. Your biggest bills of the year, number one is going to be your taxes. Your second biggest bill is probably going to be your apartment complex or where you live.
Right. Right. And for anybody that's listening to this, that's an investor, that's one key metric that I would look at. The amount of deals that hit my desk that I look at, okay, it's a simple, we're going to raise rent, reduce expenses kind of value add plan. And then you go in and look and you're like, well, you're saying you're going to raise the rent to 50% of the median income of the 3 mile radius. I don't know about you, Craig, but that doesn't sound like a sustainable business model. Like something's going to give in that model.
Without a doubt. Yeah. So it's, you know, it's really brutal, but the affordable space is where we want to play. And I think it's not no surprise that you and Chris have also found that to be, you know, a really good strategy. And then some of the really cool things about mobile home investing is some of the depreciation that you get there. You know, of course, it's sunsetting bonus depreciation, but with how, you know, car washes actually too, and mobile homes function, you get a very, very overwhelmingly handsome amount of bonus depreciation. Can you kind of touch on some of those benefits that you get that are kind of a side benefit to kind of the main piece of cake as it goes? It's kind of like the icing, I would say.
Yeah. So first and foremost, I'm not a tax professional, not tax advice. Don't sue me. I wouldn't feel the need to make that disclaimer if I haven't run into some issues there in the past. But from my perspective, like there, so mobile home parks and car washes. Let's take it in two different conversations. On car washes, when we go in and buy a car wash, we buy the express bay tunnels, so we don't do like the self serve or whatever. Those are considered operating equipment. So when you're looking at traditional multifamily, 27 and a half years, straight line depreciation, if you add in some bonus depreciation with a cost seg, you can pull some of that forward. But let's just assume you're just going to straight line it over 27 and a half. Well, car washes, since it's considered operating equipment, it's on a 15-year time scale. So already you're cutting basically your depreciation schedule in half or doubling your depreciation each year. As you know, as you alluded to with the bonus depreciation, we can still bonus depreciate that and pull that forward. So back when there was 100% bonus depreciation, we were seeing upwards to 85, 90% bonus depreciation in year one on those assets. So tremendous tax savings asset class if that is something that you're looking to do, is just pad your depreciation books. From the mobile home side, so mobile homes, it really depends on the park. But a good way to think about it is if all of the homes are tenant owned homes, then we can't depreciate those, right? Because we don't own them. However, we can make the argument back to the IRS that we just spent $10 million on this park and basically it's all land. Well, what is the value of the park then? Well, they've got the sewage, they've got different things like that, that we can make that claim that that's the actual value. That if you compare it and comp it versus a land next to it, that may be trading for $100,000, for instance, then we can say the value of the park itself that we can depreciate is 9.9 million in that example. So I still see mobile home parks on scale with multifamily. In certain situations, it can be a little bit more. But definitely in terms of depreciation, car washes offer the best. Mobile home parks are right up there with multifamily, if not better sometimes.
Makes sense. Is there any other notes you want to put to the asset classes that you're working in?
Just that we're in the private credit market. If you don't know much about that market has exploded over the
Yeah.
past.
Well, debt
Yeah.
investing has become a lot more attractive. And so I would love to understand the nuances between private credit and, you know, kind of debt funds, if there's even a difference there. So just some distinction there. But it's kind of funny. I think when yields were really far down, and, you know, the risk-free rate of return is lower, treasuries were lower and whatnot, profiles like that were probably less attractive. But now that the risk premium people are looking, it's like, wait, well, if I can make almost, you know, 9 to 12% a year on my dollars, yeah, it's taxes interest income. But if I can get that coming in, why wouldn't I just basically harp on that? And if I have to foreclose, I'll still make my dollars back. Why would I do anything different than that? Because I don't believe in the risk adjusted return profile, maybe of a multifamily investment, something of that nature. So is that kind of why a lot of people, you would say, are looking for that type of product? Or do you think it's due to where your investors are at in the life cycle of things, where they're kind of looking for more of a cash flow utility play?
Yeah, a lot of things to unpack there. So first and foremost, private credit is a fancy word for debt market, debt products, basically. Private credit, since the GFC and there were regulations that were put in place around Dodd-Frank and different lending, things like that, private credit really exploded to be a bridge gap between traditional bank financing and traditional equity plays of hey, let me buy a piece of your company. So private credit is essentially let me loan you money at a higher interest rate than you can get from a bank. A bank would never lend on that. equity is expensive to give up. So this just kind of fits that little need right there. Our private credit market is really to fix and flip borrowers out there. So the people that go out there and fix and flip homes. As you know, Bank of America is not going to lend on a property without a roof. They're just not going to do it. They have to fit into their Fannie and Freddie box of they got to check 1,500 things off their
Not
list. And if one of
conforming.
them's, yeah,
Yeah,
it
not
is.
conforming, and God forbid you put an HOA or FHA loan on that. No way.
Yeah, I could rant for the next hour about how much I hate getting mortgages through traditional banks because of all the regulations and things they have to go through to sell the note. But, anyways, we fill that gap. And what we love about our debt offering are their 6-month terms. So every 6 months, depending on if you think the world's a very volatile space right now, where every 6 months we're resetting with our borrowers, they can obviously extend. We want them to be successful in their products, but we're going to charge them to extend their loans if they want to do that. So it's just a nice way to preserve cash flow, like you mentioned. There's no depreciation, though. So I think one of the reasons why private credit has really gotten a stronghold over the past 2 years specifically is because a lot of people deployed capital during 2020 through 2022, maybe aren't seeing the cash flow that they used to. They went into this investing game into alternative assets for cash flow, and a private credit offering or a debt fund offering just makes sense. And with all some of the distress in properties today, as well as the continued interest rate increases through traditional lending, private credit just kind of fills that nice little gap there.
So what's the return profile of that? You said it's short term, longer term. Does the return profile vary on that?
It does. We offer a redemption, a 90-day liquidity provision on ours. So, which means if you invested with us today and you needed your money back, we can guarantee that we'll have it back to you within 90 days. Usually our average is 25 days because we have loans rolling all the time, but we just put a 90-day stipulation on it just in case big redemptions come in or people want to extend, et cetera. If you're willing to release that 90-day redemption and lock it up for 6 months to a year, we can offer up to 10%. But the beauty on that, Craig, is what I tell investors is like we're charging usually our borrowers 12 to 15. So that extra spread is what we keep as a buffer when we have issues with loans that go into default or foreclosure or things like that.
So you basically
So
just eat a little bit less if the loans don't go as well in that tranche, but if it goes well, then you basically collect the spread.
correct,
So you
correct,
really help your investors hedge their downside.
correct, correct.
Very cool. That's awesome.
That was a nice way to put it. I should have you
Yeah.
do that.
Yeah, right. Well, I'll also be curious to know another really unique thing that you and Chris do, which is the life insurance policy. So Chris was explaining this to me the other day in a car, and hadn't had my whole coffee yet, so my brain was only half working, but I understood roughly a little bit of it, and it sounded very unique. So I'd love for you to kind of explain the value of that product type.
Yeah. So, first of all, I'm not a licensed insurance person. I get comped no ways if you buy life insurance or if you don't buy life insurance. What I was trying to figure out, Craig, in 2018, I hit my 10 loan limit with Fannie and Freddie. So, meaning I couldn't just walk into Bank of America anymore and they write a traditional mortgage because I needed to go to portfolio lending companies, people that kept their loans on their balance sheet. And that gets a little bit hard because it's a lot of community banks, it's a lot of smaller banks. So I was thinking about like, okay, I've got great cash flow coming in. I want the ability to lever this cash flow. And how can I go do that? And I heard a podcast with a good friend, Caleb Goyams. He's a good friend of mine now, but he just explained it beautifully as like, this is a cash warehouse. It's a place you go stuff cash, it gets a rate of return, and if you ever need to borrow against it, not borrow the money, borrow against it, your rate of return will continue to compound, which is the most important thing that you can do with your money financially is continue compounding it. And you can go leverage it into other areas of opportunity. So if you are a person that needs money in your lifetime and you have great cash flow coming in and you don't want to be dependent on banks and private lenders to go get you uh, financing, then it's a great strategy. So how does that all work? Well, today rates for mortgages are what, 7%. I know they've come down here recently, but we got quoted a car loan the other day for 7.5%. Well, for the past 7 years, I've been stuffing money into a life insurance policy that I can go borrow at 5%. So I can borrow against that money while it still continues to grow at 5%, and then pay myself back the money that I'm getting from my investments so that I can go recycle and reuse that money. If I would to take out the auto loan, first of all, it's more expensive money. That's not always going to be the case. It wasn't the case in 2020 when rates were zero, but it's not. So it's not always going to be the case. But it's going to be more expensive. And when I pay that dollar, it goes to someone else. I never get a chance to reuse that dollar. So what I've done is stored my cash in a life insurance policy as a warehouse that I can borrow against, typically at a cheaper rate. I get to put it on my own amortization schedule. I get to decide when and how I pay that money back. I can wait 5 years. I can pay it back tomorrow. And most importantly, when I graduate this world, which is going to happen at some point, the chances of me dying are 100%. I get to pass down a wealth of money to my future generations. And that to me is also equally important to me. So that's kind of the short end of it. Obviously, it took me 3 months when I first heard this message of reading books, seeing examples, writing out numbers myself to kind of truly understand it. But once you understand it, you'll never look at money the same again.
So this begs the question. Obviously, you get all the upsides of it. What the heck is the downside? Like, where is the risk? Where is the caveat? Where is the string attached, as they say?
Yeah. The caveat is the first 7 years, when I pay a dollar into my policy, I only have access to 80 cents of it, essentially. It's a 7 year break even policy. Now, if you walk down to your local insurance agent, State Farm, Allstate, and Northwest Mutual, and ask them to write a policy, that's going to look like the break even is going to be 15 to 20 years because they don't understand how to properly structure these. And we can talk through what properly structured and right company means. But that's the problem. There's two things that people have a tough time getting over. One is that I gave you a dollar and I only have access to 80 cents. Yeah, but if you die tomorrow, somebody else is going to get $100,000 after your dollar. So that's a pretty good return. And then two is this idea of like whole life versus term. Why wouldn't you just buy term and invest the difference? And that really comes down to, if you're just a typical person that doesn't need access to capital because you're not an entrepreneur, you don't understand how to like play the arbitrage game of borrow at 5, invest at 10, then you're right. Go buy term. It probably doesn't make sense to you.
Yeah. Well, also, some people want it to be simple, and there's probably some nuances to this, and
100%.
uncomfortness, or also, hey, maybe you're the only one in your network who's doing that. But that's why I want to bring you on here, just to show options, because I think the deeper that I've gotten into this space, and I'm sure you can agree with this, the deeper that I've gotten, the more I realize I know nothing about money and investing and the world of opportunities that are not mainstream, but are very creative and unique, and get your thoughts thinking a lot more than just the typical strategy, if you will.
So that's right. And the one thing I want to say about that is my whole financial world changed when I realized that traditional financing advice is bury a dollar in the ground and don't touch it for 50 years and come back and there will be more dollars. Throughout most of history, that's been true. So that's not a bad plan. That's not bad
It's not
advice.
wrong. It's by no means,
It's
it's
not wrong.
better than nothing, and it's by no means wrong. However, can we optimize that?
Can we optimize that? But also, what I've noticed is that the wealthier people that I start to study, they don't think about how much can I accumulate. They think about how fast can I spin my wheel. And what I mean by that is, if I borrow a dollar at 5% and I invest it at 10%, most people think that's a 5% difference. That's 100% difference. So on a dollar, that's a very small nominal dollar amount. On $100 billion, that is a huge nominal dollar amount. So this idea of how fast can you spin your wheel, not how much can I put in the ground and hope it grows bigger, changed my financial life when I started realizing that.
Yeah, you're absolutely right. And I think some people look at gains, this, that, and it maybe seems small for now, but it's really the long-term
That's it.
horizon of it that you need to be playing for. And, I also think that when I was younger, I thought, oh, if I made this one investment, I'm done forever. But that's just not how the life works.
Mm-mm.
You're not going to have you put $100 in and, you want to make a millions thing and you're done. So you just got to keep stacking and collecting these chips and putting your dollars to work. And I've also found too, you don't have to hit home runs every single time you invest if you do it early and often enough. And you're strategic and smart with your dollars and cents coming in, going out, and you're kind of your strategy. And also just leaning into the fact that you're going to be working for longer than you maybe want. Some people at least, but that's okay.
Yep, that's it. And I just want to touch on your small comment for a minute. I have a friend who has seen me from my very beginning journey until now. And I have been begging him to join me in this journey so we can go buy a private island together and live on that island with our families and
Probably
like
in a
all
blue
these.
zone, I'd imagine, knowing you and your health needs. Yeah.
That's right. That's right. But and he's just like, Matt, I can't get excited about investing in only receiving $200 a month. Do you know what my monthly expenses are? And like that just doesn't move the needle. And now, 10 years, 15 years into this, he sees some of the success I've had and he's like, oh, I get it. And
I fumbled the bag. I dropped the ball a little bit here, didn't I?
he's like, I get it. It's not the one investment. It's the fact that you've done this 50 times now and all of that starts stacking
And
up to being real
reapplied and
money.
reapplied and reapplied. Next thing you know, it's like, oh, wait, I can do a road trip through the Oregon area like you were telling me beforehand. And I can do that. And that's out of, my cash flow dollars.
That's right.
Yeah.
That's right.
It's very interesting. I always, when my dad was speaking, who was, done well, and he's always like, time, he never complained about as much money. He was kind of a penny pincher inherently because he didn't grow up with that much and became very successful. But he always is harping on time. And you think about this, it's like, I'm investing in these Lone Star deals into my future with doing conversations like this, accumulating my network, figuring out basically the best way I can not shortcut it because there's no shortcuts in life, but how can you, contract the level and time it takes you to get where you want to go to live the life and create the lifestyle that you want to live. So I'm investing today so I can, when I'm 50, I'm 30, I just turned 30 a couple months ago. When I'm 50, can do whatever the heck I want when I want and not have to ask this or that because I've got that cash flow coming in. But if I start that journey today, I'm a couple $100,000 deep now in that. If I start that today, I will be A-okay for the future and it's just going to grow accordingly. And also there's going to be crazy years where things go down and then COVID run-ups where things go wild, right?
Yep. That's it. And have you ever read The Psychology of Money by Morgan
No,
Housel?
I have not, but I probably should now, huh?
There's a chapter on Warren Buffett that talks about like, why is Warren Buffett the greatest investor of all time? It's not his returns. There are definitely, he goes through example after example of how many people outperformed Warren Buffett. The only difference is the dude is 99 years old and he's been doing it since he's 13. Time is his biggest difference. So I always think about like compounding as money multiplied by time, like money volume multiplied by time. There's only so much you can ever put in that volume bucket. You have to have both of them to get to where you want to go.
Yeah, that's very interesting. And, it's actually reminds me of Jeremy Roll as well, who I just had on the show a couple weeks before this one as well. And he's like, yes, you will beat me very often. Jeremy's so humble about this. He's such a great guy. He's like, you're going to beat me often. He's like, you're probably not performing me, but I'm just trying to take risk off the window because he's just basically a full-time investor now. So he's like, I will just trade a T-bill and make 3 to 5% before I will ever lose $1. I need to have a couple of indicators or a clear path. It's like usually I look for, 150 basis point spread, basically, positive leverage, meaning if you've got a 5% interest rate, you need a 6.5% going in cap rate. He's looking at it as like, listen, you can beat me, and I will probably have to change and modify because I don't think it's going to get that bad. But it's like all I'm looking for is to take risk off the table. And looking for cash flow and taking risk off the table.
Love it.
And I think that's kind of what Warren Buffett has done. He's not the risky investor. He's just in it for the long haul.
Yep, that's right.
So speaking of all this, we were actually kind of joking around, but I like to ask this question to my friends. I'll ask you, of course, because you're my friend and, we're partners together. If you just had $1 million plop into your lap today, just with where the market's at right now, there's a phantom, you snapped your finger, you looked into your Chase or whatever account, and $1 million is there. With all the investments you're doing currently, with the life insurance, with multifamily, with this, with that, where would you deploy that, from a percentage bucket wise?
You're gonna, now that we've talked about the life insurance piece, I'll tell you the answer is probably in the life insurance
And then
policies.
would you put it there and then borrow out of it, I suppose?
That's right. That's
Okay.
right. Because then I could use it twice. I can put it in the life insurance policy and it's guaranteed through a contract that has never defaulted in the past 250 years that it's going to grow at 3 to 5%. And then I could borrow against it and put it in cash flow generating assets, use the cash flow to pay back the life insurance policy. And if and when I die, that $1 million life insurance policy will actually probably pay $25 million to whoever I decide to inherit it to, as well as they will also inherit any investment that I made. So again, it's a little bit complex to think, but I've used that same $1 million twice in that situation.
So say if you're not Matt Fore with the life insurance hack and cheat code, if you're just to put it straight into deals, from a percentage with the stuff that you're doing currently, it could be outside of that. You could be like, hey, honestly, I've got this house that I just would really love to buy, and that's where you want to put it. That's fair. But where would you place $1 million? Basically, if you had to basically deploy it, call it by 2026, so
Yeah.
a year and a half to do it.
Yeah, I would probably put 25% of it in some sort of private credit offering that gives me a better risk-free, risk-adjusted rate of return from a cash flow perspective. I would park probably 25% of it in some technology stocks that I really follow. I'm still big. Like, real estate is a majority of my net worth. It is not the strategy, is it a strategy? And I still have a big equity position. So I like to always tell people that so they know that I'm not, all in on one thing. And then the rest of the 50%, I'm interested in the deals that you all are doing, these like newer vintage, reducing expenses by 35% day one that you acquire the property. Like those deals are very interesting to me. And I'm still very bullish on the mobile home park space. If you are able to manage it, there's going to be some significant upside in that. If you are not able to manage it and want to work with some operators, I still think it's the best asset class from a supply demand perspective out there right now in the market.
Gotcha. So about 50 or 25% to both multifamily and mobile homes collectively. So basically 25% housing coming in, 25% stocks, 25% private credit, or is it 50 basically if you accumulate those two together?
Yeah, 44 different 25%. So 50%
Okay.
would be housing, 25% would be private credit, like better rates than a T bill, but still first lien position, so risk adjusted, and then 25% in some stocks that I kind of keep an eye on.
Makes sense. We were also kind of chatting before coming in here, which was working in a basically zero rate environment in your whole career. So, of course, if you go to treasuries, they're not 0% quite right now. They were not too long ago, but, we were talking about this. And I think it's very interesting you say that because and we're all in time of war that's flopping in front of us. So if you're, more senior, probably our age combined, this is nothing new for you. But if you are a little bit younger, like us two, that's kind of been a reality. So can you kind of explain what that has been like for you, what you kind of really draw that there? Because there had to be some conversations with some of your, of course, really successful investors that kind of made you think about that just premise to start with.
So, when I graduated college in 2008, for the first time, I think in the Fed funds history, it got dropped down to like a quarter point or 0%, basically. And ever since then, besides the Fed tantrum back in 2017 or 2018, we have been in a 0% interest rate environment. When I graduated, my dad told me that things are bad now, but Matt, you have no idea what it was like in the 70s when interest rates shot through the roof and inflation was high and all this kind of stuff. And I'm like, yeah. What are you talking about? Interest rates on a mortgage are 4%. Don't you know how expensive that is? And in 2020, they went down even further, right? So traditional, I locked in some personal rentals that I still have, my single family rentals at like 5, 4.5, things like that. And then they shot down even further, like 2.5, 3%. And he kept telling me all along. And now for the first time, when the interest rates got up to 5% in 2022, they were raised
Which feels like a
500 bips.
deal right now.
Right.
Yeah.
And they went up 500 bips in 18 months, something like that, 12 months or something like that. It became the first time I ever saw that, oh, I can put this in a savings account and get 5%. I don't have to go invest it. I could park this in a T-bill for 5%. I don't have to go take on risk to invest it. And some of our investors have said the same thing as we're kind of showing them different deals and talking through different things. They're like, yeah, but a treasury bill pays 4.5. My savings account pays 4. Why would I go and take on risk to only make an 8% pref with some upside and things like that? So it's been a very interesting transition for me. I think one, when cost of capital, when capital actually has a cost, it starts competing for other ideas out there, whether that be technology ideas that probably didn't need to be invented, whether that be overstaffing in the technology space, like we've seen here recently with Twitter laying off, 70% of the company
And
day
still
one.
running fine. Yeah.
Yeah.
There's a
And
lot of fat on the froth of the market.
a lot of fat everywhere, right? Or it's, hey, money is free. We're going to go put a bunch of shovels in the ground and build all these multifamilies wherever we can because money is free and abundant. And even if it is a so-so deal, we'll still get a great return. It's just been an interesting transition to me. And I think for the first time in my adult life or investing life, I've seen that if there is a true cost of capital and if there's a true competition, like a T-bill that is risk-free at 3%, 4%, 5%, then what does that do to different ideas in other parts of the economy? So I'm still learning, to be transparent. I'm still trying to figure out every day what that looks like, but it's so interesting to me as a finance nerd to kind of watch it all play out.
Yeah, well, so I bought my house in 2022, my first one, 485 rate, and I thought I got hosed because that was right when it was going up, and I'd sold so many houses sub 3%. Turns out 485 rate's pretty good, but
I'll
wasn't
swap
good
you.
enough. Yeah, so exactly, but it wasn't good enough where I'm like, okay, like, do I conceptually think at some point a 485 rate could come back? But I'm really about the equity play and the equity flipping of it, if you will. So I was like, this is okay, but it wasn't where I wanted to live. So I had a nice exit, and then I bought my house. Well, my rate right now is a 6.85, but I intentionally bought when I bought because it's like I know this area is good. New construction selling for more than double what my house is worth. So if you just look at the arbitrage play, that's a money glitch. I can make money on a construction project and flip it around and make a handsome amount of money and do that, which I probably will do that. But it's like I'd rather buy because obviously, just like multifamily deals, single family houses too, like prices are hurting right now by and large. When rates get cut, that's going to go up. So I always want to buy when rates are probably the highest. I do feel pretty
Yes.
confidently that we are at that interest rate high right now. But it'll be very interesting to see, now that we're in hopefully a more normal environment, what this will mean moving forward. But, with that said, if you look at what I'm doing and what I'm selling people on doing as well, or advising them, I should say, I would definitely say that I am in a position where I'm putting out more debt and levering myself up personally and, as much as possible right now, because I do think if you can get new debt right now and make it happen and make sense, and these are logical, sound decisions, we're going to have about a half decade run here where every acquisition will probably make sense just due to the cyclical nature of things.
That's right. I mean, I think I saw more than anything over the past 3 years that when interest rates rise, commercial real estate properties drop. And when commercial interest rates drop, commercial real estate goes up. Sorry, I've fumbled that completely,
Yeah.
but I think you
We
get the
know what you're
gist of
going
it.
for. Yes, yes,
Yeah.
yes, yes. Yeah.
It's just in 2023, I had an investor call who's turned out to be a good friend. And as interest rates were skyrocketing and I was about to buy my house and I was telling him about my 7% interest rate, he said, if you can afford that now, buy all you can. Because the second interest rates drop again, because I was telling him about my neighborhood, same situation, new construction everywhere. The population in this little area that I'm in Nashville has doubled in the past 3 years and continues to grow gangbusters. Is that all of that is going to be worth so much more when cost of capital goes cheaper. So not financial advice at all, but I would encourage investors to understand that if you're waiting for interest rates to drop again, prices will go up, affordability will get harder, and maybe deals won't look as good because the price has to go up.
I just think it's funny. It's like if you're an interest rate buyer and that's your philosophy, it's like, so you literally are just waiting for things to get more expensive again to buy. That doesn't make
Yep.
sense. So you're basically waiting for the sale to end on what you'd be buying regardless to buy the product. That just doesn't make sense to me. Like you're going to make money by, it being a tougher time to have it pencil. It's not as if you get interest rates cut and, it only affects, one side of it, just it's cheaper. Yeah, well, if it's cheaper, the pricing pyramid starts to come into play where if it's cheaper, it's going to push prices up because more people can afford it. It's just
Yep.
very simple economics. But I guess, some people don't think about that, or they look for every excuse to not do something as opposed to actually doing it.
Yeah, I will say this, and I would actually love to hear your rebuttal to this, is I still am a cash flow guy. I don't buy based off of equity appreciation only. If I'm going to do that, there's some, I might as well go buy Bitcoin, because at that point, I'm just making a appreciation bet. Like there's other appreciation bets that I would make that wouldn't be in real estate if that's what you're doing. So I'm still only a cash flow guy. So if you're going to be losing money in betting on that, then you are making an interest rate bet. You're not investing in real estate. So caveat that.
There is one exception to this rule. Well, I guess there's some, right? Naturally, there's exceptions. There's this that. I think on commercial real estate, it is probably a blend that I look for, which is an equity growth multiple play, and then the cash flow there. But you don't want to focus one over the other, because you could buy 10 caps in rural Alabama, but good luck on that ever
Selling it.
appreciating,
Yeah.
right? So you
Yep.
still want to be in a growth market, so you have to blend the two together. I would certainly say, a blend is nice, but the cash flow is nice because you're basically looking at, okay, well, in the event that this deal doesn't appreciate, at least I'm getting something in the meantime. It's a solid, dividend coming your way. The one asset class that I think everyone has all wrong is homes. So, and homes vary across the nation. Different markets are separate, right? But I'm in the area that I'm in right now is a really incredible zip code where you're not going to be able to buy this deal and make it cash flow. In the best real estate and best homes, you are doing that for an equity play because people do unreasonable things for unreasonable locations and schooling, and to have their kids and families and stuff and wife be happy with the community environment. So homes is the one caveat to that I will say, by and large, people are, looking for cash flow. That it's like, okay, well, if you want cash flow, specifically I'm in Phoenix. Okay, we'll go to Santan Valley and Queen Creek. Well, those are tertiary, further out markets than that are the first place in a recession and the last place out, and the last place to get rent growth as well too. So, I think people look at homes differently, and you need to look at it from that frame if you want to play the home game and make money. If you're looking for yield, listen, go to, mobile homes, do this, do that. But like, I think the perfect blend would be, of course, having some homes in core areas that probably aren't making that much money, because guess what? Everyone who bought real estate in the Bay Area didn't cash flow, but they made millions of dollars in the run up in equity appreciation. So if you want cash flow, do multifamily, and then do, of course, debt funds. And then if you want really big equity growth, of course, multifamily is great for that. But single family homes are really incredible for that. And I'm talking about buying value add plays, not, turnkey ready can go construction.
Yeah. Yeah. I mean, turnkey just means basically you've reduced all the risk. If there's no risk, there's no margin. If there's no margin, there's no appreciation.
Correct. Exactly. So that's my philosophy there. So we were also talking about this premise too, and you've done this in your podcast, and I might have to steal it from you, which is, and we've already probably gone over some of the concepts, but if you want to go through it once more, which is, what have you learned over the last 4 years?
I think it's that. There's two things. One is the cost of capital, and it matters. And specifically in commercial real estate, you should not finance long-term plays with short-term debt. And that is a concept that I think I saw somebody say in 2020, and I didn't understand what it meant. And then in 2022 and 2023, as rates were adjusting and everything like that, I was like, oh, I get it now. I understand. So, and what that basically means is if you've got a play where you're buying a stabilized asset, it's a turnkey, everything, the value's been stripped from it, and you're just looking for little bumps along the way and reducing expenses where you can, sort of thing. Don't finance that on a 2-year IO adjustable rate
Play,
mortgage. Yeah, that's due in 3 years kind of thing. And the cost of capital matters. How you finance things matters. The last thing is supply. And so I started my real estate career, and look, everybody in this business learns through mistakes. You never learn when you're winning. Michael Jordan didn't start off beating the Pistons and going to the NBA finals and winning all the time. He had to get his butt kicked as well. And when I started off, I was buying in a nice little pocket of Nashville that was brushed over from all the development. It kind of got looked over during that time, and it was just starting to get a look at. And I was in the second, if not the hottest market in the country. And I thought this stuff was easy for like 3 or 4 years. Everything I bought the next year had already appreciated like 5-10%. I'm like, this is so easy. I'm so good at this game. Nashville is probably one of those markets right now that's still a little bit oversupplied. Austin, if you bought in Austin, if you're developing in Austin right now, you're going to get crushed for the next 5 to 10 years, I think. And Austin's a great city. A lot of people still moving there. A lot of
It
shovels
will
went
it
into the
will
ground.
rebound, but it's gonna take some time to
It's
get it to par.
it's the Miami of the GFC. And Miami and Fort Lauderdale got crushed during the GFC for the same exact reasons. They saw a bunch of people moving there. They knew they needed to develop. They tried to get it done quickly. Then some sort of black swan event happened. So I would encourage investors, like, the things that I've learned during this time is your buy price matters, but I always kind of knew that. And I think I've always done a decent job at that. Your debt matters. I don't think I've always done a good job at that. And I've learned some lessons along the way, specifically in my single family portfolio, not in a lot of our commercial stuff, but in my portfolio. And then ultimately, supply matters as well. Supply is kind of a tertiary metric that I would look at if everything else made sense. But it is something you need to look at before you go invest in large commercial assets, making sure there's not competition coming right next door.
Yeah, supply is crucial in anything. I mean, obviously, supply demand. That's probably the first thing they tell you in econ, right? Is econ 101 is supply demand, but seriously, it's very important for homes as well, and that's why for the homes, why in this area I would invest in where I'm at currently is because hey, the math just makes sense, right? And similarly in Houston, what we look for is we want to be in areas where within a 2 mile radius there's nothing under construction or in plan to be done because delivery is just going to knock down the value of your property. So it's really that simple. Some of the other things, don't overthink it. Be in a growth market, be in a market in that sense that will do well, and you will generally do well as well.
It's funny you say that. I just kind of look that I don't even mention things like that because it's so inherent to my thinking now. But we only play in major metropolitan area. Some of our mobile home parks are a little bit fringe, like 20 minutes outside of a bigger city sort of thing. But for all our commercial assets, it's all in. If it has an NFL team, we're looking at it. If it doesn't, we're probably
That
passing on
really
it
is
as a
is
good
the
example.
baseline test. That's why Austin is such an anomaly in many respects, but it's got UT for that. But it's like, hey, it's professional sports town. Okay, that means something. You got three
Right,
teams or two teams. Okay, makes sense.
right, right. Just make sure
So Vegas is
population's
back
moving
now with
there.
the A's coming.
There you go.
Yeah,
There you go. There
yeah,
you go.
good stuff. Matt, you've been so great. Final couple questions or thoughts here. Do you have any personal hot takes that are kind of personal to you, or maybe perhaps a little bit contrarian that you have that maybe less people do, or something that's just more of a core philosophy that you kind of, I guess, maybe live by or go by?
Two that I'll say that we're trying to teach our kids right now is one of them. You don't have to yell to be heard. If you're yelling, your argument's not good enough. You need to rethink your argument before you yell. I'm not a yeller. I've never been a yeller. Don't like people that are yellers. Just never think it's a good position to
It's
be
not.
in.
It's generally not constructive.
Yeah, you're generally not in power if you're yelling. Um, the second thing is, I had somebody give me this advice early in my career that I've always tried to adhere here to, and that is meet people where they are. And what I mean by that is sometimes emotionally people are in a different state than you are. And when you're meeting with them, you need to meet them where they are. Sometimes they're at a different state and across the country. And if the meeting requires it, you need to go meet them where they are. And I think it's just an overall leadership philosophy. Too often times, specifically in our political climate right now, you're standing on one side of the room, I'm standing on the other, and I'm shouting at you. One of the things that my partner says about me all the time is she says, you have just this unique way of understanding people's point of view. And I think we need more of that in the world. So if you're ever in a disagreement, if you're ever in an argument, no matter how small or big it is, try to see it from that person's perspective, meet them where they are before trying to bring them to where you want to go.
Matt, that was very wise and stoic of you. Where can people find you if they want to learn more, reach out, or invest with you and Chris are good friends?
Yeah, so I have a podcast as well called Ice Cream with Investors. Yours truly, your host, was on it. We'll have to go dig out that episode and put it in show notes.
Yep.
But come check us out on any podcasting out, Ice Cream with Investors. And then if you go to icecreamwithinvestors.com, there's a link to my calendar there. I clearly love talking about this stuff. I love helping people figure out where they want to be in their journey, active, passive, private credit, equity positions, all that sort of stuff. If I can add value to you, it's my duty to try to do that to to the world. So please book some time and would love to connect.
Incredible. And you're going to be at a summit event, correct, coming up here in September?
I'm getting married that week, so I'm not sure
Oh,
yet. I think
oh.
I might get a little side
That's a
eye
good
if I came.
excuse. That's a good excuse. Fair enough. Well, really grateful that you are on the show today. We're looking forward to hopefully seeing you soon in Tennessee when I'm there next. I'll have to message you and get together. But thank you so much for being here. And for all those who are listening, thank you so much. And we'll see you next week.